Hey everyone, welcome back to Corporate Decoder. Today, we're diving into Titan Environmental Solutions' latest SEC filing. This report is a real mixed bag, kind of like finding a shiny new toy in a pile of old tires. Let's see what treasures and trash we can dig up, shall we? Alright, first things first. This is amendment number 4 to their registration statement. Basically, they're tweaking their filing to get ready for a stock offering. Titan Environmental Solutions, Inc. That's the name. They're registered in Nevada, but their main office is in Bloomfield Hills, Michigan. Seems like a long commute if you ask me, especially with Michigan weather. They tell us their main business code is 4212, which means they are in the trucking business. Not a lot of environmental solutions here initially, but we will see about that. And their tax ID is, well, important for the government, not so much for us. The main guy to talk to is Glenn Miller, the CEO. So if you have any questions, Glenn is your man. They are a non-accelerated filer and a smaller reporting company, meaning they get a little more leeway on when and how they report things. Okay, here we go. A summary of what they do. Titan is trying to be an all-in-one shop for non-hazardous waste. Think collecting your trash, hauling it away, and dealing with it responsibly. Their main business right now is through Standard Waste Services, LLC, SWS. Standard provides trash collection for businesses in Michigan. Titan bought SWS in May last year. They want to grow and become a leader in the waste industry. Here's their plan. First, buy up smaller waste companies. Second, make things cheaper by combining operations. Third, get into the landfill business. Fourth, grow on their own by getting more customers. They are looking at the Midwest, Northeast, and Southeast areas. They want to avoid big, tough cities and focus on places where they can be a big fish in a smaller pond. They also want exclusive contracts with cities. That way, they have a guaranteed customer base. Management want to run each location like its own business. That way, they can stay nimble and react quickly to customer needs. Basically, they are saying they will cut costs, train employees well, and give better customer service. Plus, they're going green by dealing with more waste themselves in their own landfills, if they can acquire some. Of course, there are risks. For instance, they just recently got into this environmental solutions business in January 2023. They've been losing money and might keep losing money, and they might need more money and need more financing, which could make existing shareholders own less of the company. Oh, and there is a chance they might go out of business if they don't make money. Cheerful. They might not be able to find good companies to buy, or they might buy companies that don't work out. There's also more competition to buy these waste companies. If they grow too fast, they might not be able to handle it. They might also have problems from old companies they bought. They depend on a few big customers. If they lose those customers, things could get tough. Also, environmental laws are tough, and they could get sued. They could also have accidents and hurt people, so accidents are another possible risk. They might lose contracts with cities, and labor unions might try to organize their employees, so management are probably a bit preoccupied. And the listing for their stocks on the NYSE American LLC might not get approved, or shares might get taken off the stock exchange. So lots of risks here. If they issue more stock or warrants, that will mean the current shareholders get diluted, and new investors will suffer immediate dilution in net tangible book value. That is, they will be worth less immediately after this stock offering. Wow, that risk section was intense. Let's move on to something positive maybe. In May last year, they bought Standard Waste Services, SWS, for about $16 million. At that time, SWS had about 20 trash trucks and served over 750 businesses. Also, they sold their food waste, digester business, Recoup Technologies, for $1 million. Between April and May last year, they sold shares of preferred stock and warrants for about $4.2 million. So they are raising a bit of money. They will be doing a reverse stock split before this stock offering where every 100 shares become one. It is like taking $100 bills and turning it into one big bill. Now for the money. They have been losing money. A lot of it. They lost about $18 million in the 9 months ended September 30th, 2024. Their revenue, the amount of money they made, was $8.3 million for the 9 months ended September 30th, 2024, but their costs were higher, so that means they lost money. They say if they bought SWS and sold Recoup earlier, they would have made about $11 million in revenue and lost about $8 million. Time to meet the team. Glenn Miller is the CEO and chairman. He has tons of experience buying and running waste companies. Michael Jansen is the CFO. He knows the waste business inside and out and has 30 years of experience in the waste business, so I guess he knows his waste then. Richard Berman, Frank Celli, and AJ Sicca are also on the board. They have experience in business, venture capital, and, well, one of them had the same role before, so they know the business. It's not a bad group. Now, what will they do with the money from this stock offering? They want to buy strategic assets, pay off about $1.7 million in old debts, and approximately $1 million for other bills that they have not paid yet. Alright, so we have 400,000 shares of common stock and 25,000 shares of preferred stock authorized. Now, let's get into legal stuff. These shares all have certain rights. Each share gets one vote. No special treatment or preemptive rights. If the company shuts down, everyone gets a fair share of what's left, if anything. Also, there is talk about a reverse stock split of 1 for 100. Sales of a large number of shares could depress the prices of the company. An underwriter may help the company to issue the stocks. Okay, so that's the report. Lots of risks, lots of plans, and lots of potential. Now for my take. On the one hand, Titan has a clear strategy for growth. They want to be a regional leader in a relatively stable industry. They have experienced management. And hey, everyone needs trash pickup. On the other hand, they have a history of losses, a lot of debt, and they will need to prove they can actually make money and integrate acquisitions. The risk section was really scary, and so many different type of stocks, warrants, options. I got a headache just reading the description. Still, given their focus on a boring but reliable sector, waste disposal, and an experienced management team, if they can execute, the market is looking positive. I'd estimate a fair price range, assuming they can get that NYSE American listing approved, of $4.75 to $5.75 per share. However, their high level of debt needs to be monitored closely. So my conclusion? I'm cautiously optimistic, but this is not a stock for the faint of heart. If they can execute, the potential is there. If they cannot, then be prepared to lose your shirt. If you found this breakdown helpful, please subscribe, like, and hit that notification bell. Let me know in the comments what SEC filing you'd like me to decode next. See you in the next one.